Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of May 15th. Well, all year we shared with you our concerns about the market. High valuations, earnings slowing, the Fed pushing us into a recession. And as a reminder, we do expect a better second half of the year for the markets. In the last couple of weeks, a new concern has arisen, the potential debt ceiling crisis. This Friday, President Biden and congressional leaders are scheduled to meet. This is an ever-changing situation, but let's discuss two things. What do we know? And second of all, what are the ramifications? Of course, I'm going to keep politics out of this entire discussion. So let's start with, what do we know? The U.S. has a statutory debt limit. This is a legislative limit on how much debt the government can take on. This so-called debt ceiling has been hit so many times in the history of our country. For example, since 1960, Congress has acted 78 separate times to permanently raise, temporarily extend, or revise the definition of the debt limit. Each time this occurred right before the Treasury ran out of money. The issue today is that the current debt ceiling was hit back on January 19th. Since then, the U.S. Treasury has been using so-called extraordinary measures to finance the government. The nonpartisan Congressional Budget Office and the U.S. Treasury both expect these measures to run out in early June. The ramifications are huge. A potential default on our debt if the Treasury does not prioritize debt payments over other outlays. Investors are clearly worried. You see here, for example, that credit default swaps have surged. Not enough time to explain what those are, but just think about this. The higher they are, the more risk there is in the overall market. So the failure to raise the debt ceiling has ramifications. Failing to raise the debt could cause the government to not meet legal obligations, like paying Social Security, like paying Medicare, like interest on debt. If Congress disagrees on this debt limit, this could potentially lead to a default on U.S. treasuries, which could lead other countries to be less willing to buy our treasury bonds. If a default did occur, the government would likely delay payments to bondholders, and the ramifications could be huge. A potential downgrade by rating agencies like we saw in 2011, more market volatility, and just a worsening economic situation. And furthermore, if you think about it, what cannot be measured is that indirect effect from businesses. This Washington uncertainty and the potential effect on the economy. Companies may be reluctant to increase capital expenditures or even hire additional workers. Not good for the overall economy. So the key takeaway is that it's possible, but not probable that this debt ceiling fight could cause a U.S. default. Again, it's possible, but not probable. There's lots of political brinksmanship in Washington, but default is not good for either party. However, until a resolution is found, the stock market will likely continue to be under pressure. Investors do not like uncertainty, as evidenced by the fact that the S&P 500 has fallen in 4 of the last 6 weeks. Thank you for listening. For more information, please follow us on Twitter at CeteraIM, and see you next week.